Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cousins Properties Incorporated Annual Report. Cousins Properties Incorporated offers a range of businesses and services that cater to the real estate investment needs of its clients. The company's primary focus is on investing in Class A office buildings located in high-growth Sun Belt markets. This includes developing, acquiring, leasing, and managing high-quality real estate assets. The company's comprehensive strategy involves three key areas: a simple platform for efficient operations, trophy assets that provide long-term value, and opportunistic investments to capitalize on emerging trends. By leveraging its extensive expertise and experience in the industry, Cousins Properties Incorporated creates shareholder value through its diversified approach to real estate investment. The stock price of Cousins Properties Inc. has dropped by over 13% in the past year due to a combination of broader market trends and specific company-related news and financial performance. One key factor is the declining occupancy outlook, with projections indicating a decrease in occupancy to 89.2% by year-end 2025 from 90.1% at mid-2025. This decline was partly influenced by the departure of significant tenants such as Bank of America. Broader economic concerns also played a role, including slumping national job growth and recessionary fears that have diminished demand for office space and tenant commitments. The ongoing trend towards remote work has further reduced demand for office space, contributing to downward pressure on stock prices. Additionally, higher interest costs and anticipated layoffs into 2026 have impacted the company's financial performance. Specific company events also contributed to the decline in stock price. In February 2025, Cousins Properties released its financial results for the previous year, which showed a decrease in occupancy and an increase in interest expenses. The company's acquisition of The Link in July 2025 was seen as a strategic move, but acquisition announcements sometimes coincided with slight share price declines. In December 2025, an analyst downgraded Cousins Properties from a buy to a hold rating, citing persistent sector headwinds and a lack of consistent improvement in fundamental performance. The company's most recent financial results, released in February 2026, showed a decrease in occupancy and an increase in interest expenses. The acquisition of 300 South Tryon on the same day was met with negative reactions in the stock price. Overall, these factors collectively contributed to the decline in Cousins Properties Inc. stock price over the past year. Cousins Properties Incorporated maintains a market capitalization of $4 billion, broadly in line with the industry peer group. Cousins Properties Incorporated trades at a higher price-to-earnings ratio of 74 times and a higher price-to-book ratio of 0.92 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.93%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the growth side, acquisitions of office properties and leasing activity are significant contributors. The increase in same-property net operating income, acquisition of assets with above-market leases, and amortization of intangible assets related to acquired in-place leases also contribute to revenue growth. Additionally, an increase in second-generation straight-line basis net annualized rent and cash basis net rent per square foot indicate a rise in rental income. These factors collectively drive revenue growth. On the decline side, lease terminations with termination fees, early termination options exercised by tenants, and decrease in office portfolio occupancy rate are primary drivers of revenue decline. Prepayment risk in real estate debt investments, interest rate fluctuations affecting market price of debt investments, delinquency, foreclosure, and loss of mortgage loans secured by commercial properties also contribute to revenue decline. These factors highlight the importance of managing leasing activity, property acquisitions, and debt investments to mitigate potential risks and maximize revenue growth. The net income of the company experienced a significant decline between 2024 and 2025. The main reasons for this decrease were impairment risks, leasing risk, tenant and market concentration risk, uninsured losses, and condemnation costs. These factors resulted in a net income decrease of $5,329. However, despite these challenges, the profit margins showed an increase. This was largely due to increased leasing activity and rental rates, which contributed to a 2.8% rise in same-property NOI. Additionally, the net operating income from unconsolidated joint ventures increased by 86.6%, further boosting profit margins. The decrease in net income can be attributed to various risks that affected the company's performance. These include impairment risks, leasing risk, and tenant and market concentration risk, which collectively resulted in a 36.1% decline in net income. On the other hand, the increase in profit margins was driven by factors such as increased leasing activity and rental rates. In summary, while the net income experienced a decline due to various risks, the profit margins showed an improvement driven by increased leasing activity and rental rates. The company's financial performance indicates a steady improvement in its ability to generate cash from its core operations. The data shows that the net cash provided by operating activities has increased from $400,233 in 2024 to $402,275 in 2025. This increase suggests that the company is becoming more efficient in managing its day-to-day operations and generating cash flow. This positive trend is a significant indicator of the company's financial health, as it demonstrates its ability to generate sufficient cash to meet its obligations and invest in growth opportunities. The generation of positive operating cash flow also provides the company with flexibility to make strategic decisions, such as investing in new projects or paying dividends to shareholders. Overall, the data suggests that the company is on a stable footing financially, with a strong foundation for future growth. The company's financial situation has undergone significant changes in the past year. A closer look at the data reveals that the total liabilities of the company have increased from $3,931,979 in 2024 to $4,187,930 in 2025, indicating a rise in debt level. This increase is evident across various reports, including page 58, which states that interest expense has also seen a substantial jump. The most striking change, however, is the significant increase in interest expenses. According to multiple sources, including pages 34 and 35, interest expense has increased by $36,765, 30.1%, from 2024 to 2025. This represents a substantial rise of $36.8 million, 30%, between the 2 years. Furthermore, page 36 highlights an even more dramatic increase of $5,224, 116.5%, in interest expense from 2024 to 2025. In conclusion, the data clearly indicates that both debt level and interest expenses have seen significant changes in the past year. The company's financial situation has become more challenging due to these increases, which warrant careful attention and consideration for future planning and decision-making. Management is outlining a clear strategy for the company, focusing on creating value for stockholders through ownership of premier office properties in Sun Belt markets. To achieve this goal, they will employ a disciplined approach to capital allocation, including strategic acquisitions and dispositions of non-core assets. The company aims to maintain a portfolio of newer, more efficient properties with lower capital expenditure requirements. Management is optimistic about the company's prospects, citing the continued outperformance of Sun Belt markets compared to the broader office sector. They believe that their trophy portfolio is well positioned to benefit from and ultimately outperform in the current real estate environment. However, they also acknowledge several risks and challenges, including uncertain economic conditions, climate change, and joint venture structure risks. Management's priority is liquidity, ensuring that the company can meet its obligations for the foreseeable future. They are focused on growing their portfolio through targeted acquisitions, while maintaining a disciplined approach to capital allocation. Overall, management's strategy is centered around creating value for stockholders through strategic investments in premier office properties in Sun Belt markets. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the company purchased The Link, a lifestyle office property in Uptown Dallas, for $218 million. Additionally, the company acquired equity interests in Radius, 110 East, and St. Anne through pledges, with carrying values ranging from $0 to $18.2 million. The divestitures made by the company include selling a bankruptcy claim with SVB Financial Group for $4.6 million and repaying privately placed senior notes worth $250 million at maturity. Furthermore, the borrower repaid a mortgage loan of $138 million in January 2025, marking another significant transaction. These acquisitions and divestitures demonstrate the company's strategic efforts to expand its portfolio while optimizing its financial position. The company's financial performance reveals a consistent history of paying dividends to its shareholders. According to the extracted summaries, the company has indeed paid dividends in 2025, 2024, and 2023. Specifically, it declared $1.28 per common share for each year, totaling $215.8 million in 2025 and $195.4 million in 2024. This indicates a commitment to returning value to its investors through dividend payments. However, the summaries do not provide any information regarding share buybacks by the company. It appears that the company has focused on paying dividends rather than repurchasing shares from the market. Concerns about supply chain disruption. A growing issue, the recent reports have highlighted a pressing concern regarding supply chain disruption. Specifically, mentions of this issue can be found on pages 4 and 12 of the document. This suggests that there are potential risks associated with the smooth operation of supply chains, which could have far-reaching consequences for businesses and economies. While inventory buildup is not mentioned as a concern in the report, the focus on supply chain disruption indicates that companies may need to reassess their logistics and distribution strategies to mitigate these risks. By understanding the root causes of supply chain disruptions, organizations can take proactive steps to prevent or minimize their impact, ensuring continued business operations and customer satisfaction. That concludes the financial summary for Cousins Properties Incorporated. Feel free to comment below, and I will be happy to answer them when possible.